There are hundreds of trading strategies out there. Fibonacci replacements, Elliott waves, supply and demand zones, and the list goes on and on and on. If you're like most people, you probably tried a few, gotten confused by a few more, and you're still not sure which ones are actually worth your time. So today we're going to fix all that. In the next few minutes, I'm going to walk you through every major trading strategy, what it is, how it works, and honestly, whether it's worth bothering with. By the way, I'm Steve Reitmeister. I spent over a decade as the editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen, where our quant team analyzes thousands of data points to find the stocks most likely to outperform. So hit that like button if you want more videos like this one, and don't be shy. If you have a topic you'd like to see covered, let me know in the comments section below. We're going to start with the basics. The first batch of strategies are related to key levels. This is foundational stuff, okay? First up, support and resistance. This is one of the most elementary concepts in technical analysis. Support is a price level where a stock is repeatedly bounced off the bottom and buyers keep stepping in at that price. Resistance is the ceiling, or the level where sellers tend to show up and push the price back down. The idea is straightforward. Buy near support, sell near resistance. And while it sounds basic, you'll be surprised how many traders skip this right past this and jump into more complex tools before they can even read these key levels on a chart. Next, we have trend lines. Same concept, but diagonal instead of horizontal. You draw them along the lows in an uptrend or along the highs in a downtrend. An upward trend line is bullish. A downward one is bearish. And when price pulls back to touch the trend line, that's often a solid entry point. Now, number 3, dynamic support and resistance. These take the same core concepts just a step further. Instead of drawing static lines, you use indicators like moving averages as your levels. The advantage is that these levels move with the price, so they adapt as the market evolves. You'll often see the price bounce right off of key levels like the 50-day or the 200-day moving average like clockwork. Fibonacci replacements are a little more advanced. You identify a swing low and a swing high in your chart, and the tool automatically draws horizontal lines at key Fibonacci ratios, the 0.382, the 0.5, and the 0.618 being the most common. Traders watch for price pullbacks to one of these levels before continuing a trend. The 0.382 level tends to be the most common bounce point. Word of caution here. Fibonacci's levels on their own aren't magic. You want to combine them with other confirmation signals before making a trade. Don't just buy because the price touched the line on your screen, right? And then we have supply and demand zones, also called order blocks. These are similar to support and resistance, but instead of single lines, you're looking at zones, areas where significant buying or selling pressure occurred in the past. If prices move sharply upward from a level, that's a demand zone. If they drop sharply, that's a supply zone. Prices tend to react when they revisit these key areas. So what's my take on the first group of strategies? Support, resistance, and trend lines are where every trader should start. Support and resistance are the foundations. Fibonacci and order blocks, they build upon them. If you can't read the basic levels, then the more advanced stuff won't be helpful at all. Now let's move on to chart patterns. We'll start with candlestick patterns. These are about reading the shape of individual candles for quick clues about what's happening. An engulfing candle, which completely swallows the previous one, tells you there's been momentum in that direction. Other patterns like hammers and shooting stars have long wicks on one side and let you know the price got rejected at that level. And doji candles, where the open and close are almost identical, signal indecision. All right. There are a lot of candlestick patterns. My tip here is to get familiar with the anatomy of a candlestick and what each element of it means. After that, you can drill down and master a couple of the specific patterns. These are useful as quick visual reads, but don't treat them as standalone signals. A hammer forming right at a key support level means something, whereas a hammer floating in the middle of nowhere, well, not so much, right? Next up, we have breakout patterns. These occur when prices have been consolidating in a tight range, building up energy, and then suddenly make a sharp move in one direction. The key formations to watch for are wedges, triangles, and rectangles. Each signifies a different sort of setup. The play is to identify the consolidation and enter when the price breaks out. Here's the downside. False breakouts happen quite frequently. Price breaks above resistance, everyone piles in, and then it reverses right back down. No signal works on its own. That's why volume confirmation matters so much. A breakout on heavy volume is far more trustworthy than one on light volume. If you want to learn more about these bullish patterns, scan the QR code to check out our detailed blog on the subject. All right, next up we have reversal patterns. These suggest that current trend is about to change direction. Double tops and double bottoms are the most common ones you'll see. Triple tops and bottoms are less frequent but tend to be the stronger signals when they show up. Head and shoulders pattern is probably the most well-known reversal pattern out there, thanks to its distinct shape with a peak, a higher peak, and then a lower peak. One thing to remember with all reversal patterns is they take time to develop. The longer the time pattern has been forming, the more significant the reversal tends to be if and when it finally plays out. Now, the Elliott wave theory is next. This strategy suggests that markets move in predictable cycles. To be specific, 5 impulse waves, numbered 1 through 5, followed by 3 corrective waves labeled A, B, and C. There are specific rules to follow. Wave 2 can't retrace beyond the start of wave 1. Wave 3 has to be the longest among waves 1, 3, and 5, and wave 4 has to stay above the peak of wave 1. The Elliott wave is theoretically elegant. The issue that it's notoriously difficult to apply in real time. Counting waves after the fact is easy. Counting them as they're forming is a whole different challenge altogether. There are also more advanced patterns like harmonic patterns, the butterfly, the bat, the crab, that use precise Fibonacci ratios to identify specific price formations. They're legitimate tools, but they're deep water. If you're not already comfortable with the basic breakout and reversal patterns, I'd say skip these for now and come back to them when you got a more solid foundation in place. Okay. We're done with the chart patterns, and here's my take on them. Breakout and reversal patterns are the real workhorses in this category. They show up consistently, and they work across different time frames. Elliott waves are interesting in theory, but in my experience, very few traders apply it with real consistency. Focus your energy on the patterns that show up regularly and give you something actionable. And by the way, if you're finding this breakdown useful, hit subscribe and the notification bell. We put out videos like this every week to help you make better investment decisions. It just takes a couple seconds and you won't miss any of our next videos. All right, now it's time to talk about market structure. This is the backbone of price action analysis, and the concept is pretty straightforward. In an uptrend, price is making higher highs and higher lows. So each peak is higher than the last, and each dip is shallower than the last. In a downtrend, you get the opposite. Lower highs, lower lows. Simple concept, but it tells you something really important about who's in control right now. Is it the buyers or the sellers? Break-a structure is when the price pushes through the previous high in an uptrend or the previous low in a downtrend. It confirms the trend is still intact. For price action traders, this is the bread and butter. Since the trend is still going, you're free to look for entries in that direction. And then when you have a change of character, which is the opposite of breakage structure, this is your early warning system that a trend might be reversing. If you've been in an uptrend with higher highs and higher lows, and then price breaks below a previous low, that's a change of character. Something has shifted. It doesn't guarantee a reversal, but it's telling you to pay close attention. And then there are fair value gaps. These form when a candle creates a gap between the previous candle's wick and the next candle's wick, usually because of aggressive buying or selling pressure. These gaps tend to act like magnets. Price often comes back to fill them before continuing the move. Market structure is generally useful whether you're a day trader or a long-term investor. Understanding who's in control of the trend is never wasted knowledge. It's the kind of foundation that makes everything else you do just a little bit clearer and easier. Okay, now we're getting into the indicators and oscillators. This is the biggest category, and honestly, it's where most traders either find their edge or drown in the noise. So let's sort through it all. All right, first we'll deal with momentum and trend indicators. These are built for trending markets. Moving average, convergence, divergence, or MACD uses crossovers to indicate trend direction. When the MACD line, which is usually blue, crosses over the signal line, which is usually orange, that's bullish, and vice versa. Moving averages are even simpler. If the price is above the average, that leans bullish, and if it's below, it leans bearish. Parabolic SAR plots dots that flip above or below the price. If dots are below the price, that's bullish, and if dots are above the price, that's bearish. Lastly, the super trend gives you a color-coded line, green for bullish, red for bearish. These work great when the market is actually trending. The problem is when the market is chopping sideways, they'll give you false signal after false signal. That's not a flaw in the indicator. It just means that these are the wrong tools for the current market conditions. Now, oscillators are the flip side of momentum and trend indicators. They're designed for choppy and sideways markets. The Relative Strength Index, or RSI, measures whether a stock is oversold or overbought. Values below 30 indicate oversold conditions, whereas values above 70 indicate overbought conditions. The stochastic oscillator works on a similar principle, with two lines crossing in extreme zones. The key thing to understand is this: don't use oscillators in strong trends. A stock that's reading as overbought during a powerful bull run can stay that way for months. Traders who keep shorting it because the RSI says it's overbought are going to have a very bad time. Okay. Bollinger Bands put a volatility envelope around a moving average. When the bands squeeze tight together, it means volatility is compressing, which usually means a big move is coming. You just don't know in which direction yet. When price rides along the upper or lower band, the trend is stronger. This is a nice hybrid tool. Both trend following and mean reversion traders can find a good use for it. It's one of the more versatile indicators out there. Now let's talk about volume indicators. Volume is a key part of technical analysis because it confirms price moves. If price breaks out and volume is surging, that breakout is much more likely to be real. The key tool here is the basic volume bar. The taller the bar, the more shares are being traded. Now, VWAP, which stands for Volume Weighted Average Price, acts like a moving average that institutional traders pay close attention to. Price above VWAP is a bullish signal, and when the price is below VWAP, that is a bearish signal. Finally, volume profiles show you horizontally where the most trading activity has occurred. Those levels tend to act as magnets for increased trading activity. The final part of this category is divergence. This happens when price is going one direction, but an indicator like RSI and MACD or stochastic is going the other direction. For example, price is making higher highs, which looks bullish, but the MACD is making lower lows. That's bearish divergence. One of the more reliable early warning signals that a trend is running out of steam. What do I think about all these indicators and oscillators? Well, they're really nice tools. They're just not crystal balls. Over-reliance is a real risk here. The best approach I've found is to pick 2 or 3 that complement each other: a trend indicator, an oscillator, and volume. That's your toolkit. Every indicator you add beyond that is just adding noise to your decision-making process. You might have to fiddle around with them to figure out which ones work best for you, but do try and keep it simple. Everything we've covered so far is about reading charts and using tools and techniques for analyzing price. Now, let's shift gears and talk about how you should actually trade this information. The approach you choose matters just as much as the tools you apply. Now, scalping is the fastest approach out of them all. You're in and out of trades within seconds to minutes, grabbing tiny price moves over and over and over again. It requires fast execution, tight spreads, and the ability to sit in front of a screen all day with intense focus. It's high stress and high frequency. And if I'm being perfectly honest, it isn't a good fit for most individual investors. Now, swing trading is where you hold positions for days to weeks, capturing a swing within a larger trend. This uses most of the strategies we've already covered: breakout, support and resistance, and indicators. It's probably the most popular approach for retail traders who have day jobs because you don't have to be glued to your screen every minute. By the way, if you're looking for great stocks now, then check out a free report I created featuring 3 stocks I believe could double or more in the coming year. Just scan the QR code or check the link in the description to access it for no cost. All right, back to the trading styles. Position trading is the slowest of the active trading approaches. Within this approach, you're holding for weeks to months, riding larger trend moves. It comes with less screen time, bigger profit targets, and wider stop losses. This overlaps quite a bit with longer-term investing, and it's well suited for people who want to be a bit more active in the market, but don't want trading to become a second full-time job. Mean reversion is the idea that price tends to snap back to its average after it's made an extreme move in either direction. Bollinger Bands and RSI are the go-to tools here. You're essentially betting that any overdone price move will correct. It works well in range-bound markets, but it can be dangerous in strong trends because sometimes what looks like overdone price moves just keeps on moving and going, right, with serious momentum. And then there's gap trading. This is when a stock opens significantly higher or lower than the previous day's close, usually because of overnight news, an earnings report, or some other major catalyst. Gap and go traders ride the momentum of that gap, whereas gap fill traders bet that the gap will close and price will come back to where it was. 2 very different plays from the same basic setup. We've covered a lot of ground here, so let me share a key insight to put it all into perspective. Your approach has to match your lifestyle and your personality. If you have a full-time job, scalping is not realistic. Don't kid yourself about that, right? If you can't stomach watching position pull back 10% before it turns around, position trading probably isn't that right for you either. Be honest with yourself, right? The best traders I've known over the years typically master 2 or 3 strategies and pretty much ignore the rest. The real skill is picking the ones that match your style, then applying them with discipline over and over again. That discipline is usually what separates the winners from the losers. Now, all the strategies we just went through help you figure out when to buy and when to sell. But there's an equally important question that a lot of traders overlook, and that's what to buy in the first place. All the chart reading in the world won't help you if you're trading fundamentally weak stocks. That's why we built the Zen Ratings Quant model, reviewing 115 fundamental factors every day for the universe of stocks. Then we distill that down into a straightforward ADF grade. Indeed, A-rated stocks are the most likely to outperform. I'll leave a link in the description if you want to check it out on WallStreetZen.com or scan the QR code. If you want to make this video actionable right now, follow up with our recent breakdown of how to read stock charts.